everybody, John King with Summit Funding. Thank you for joining me today for my Financial Friday live stream. Super excited to be joining you again here on the last Friday in February. I can't believe we're 2 months into 2023. The year is going strong, and I'm hoping that you're having a great start to the year. It's definitely been a volatile start to the year for the mortgage and the real estate world. And I appreciate you guys trusting me to guide you through the financial world and help you with mortgage, real estate, finances, and pretty much anything I can do to help you improve your financial position. Today, I'm talking about a really, really fun topic. My topic today is going to be on down payment assistance. And down payment assistance, hey, Kathleen. So by the way, you can see your name on the screen if you just say hi to me. So feel free to post anybody into any of the live stream systems you're watching in, and you get to see your name on the screen. So today I'm going to talk about a topic that's near and dear to my heart, and that is down payment assistance. And down payment assistance is so misunderstood. It is such a confusing topic that people think they understand what it's about, and they really have no clue. And what's worse, it changes on a pretty regular basis, and there's a lot of myths and misunderstandings about down payment assistance. So today I want to talk a lot big picture of things you need to know if you are a consumer, a buyer, potential home buyer who wants to buy a home using down payment assistance. Or you're a real estate agent who's looking to help your clients with down payment assistance. You need to know what works, what doesn't work, what goes together and what doesn't. I hear all of these things, and I just have no idea which ones apply to my clients. And actually, the most important thing that most realtors miss, how can I use this in my marketing to help find people that want to buy a home that don't even know that they qualify? So it's critical to understand how down payment assistance works, not necessarily from a literal, these are all the components of it, but from a bigger picture of some of the value adds, some of the benefits, some of the myths that people think are true that aren't, and some of the things people think aren't true that really are. So that's what I'm going to focus on today, is to really help you guys with down payment assistance and navigating those waters. So the first thing I want to start with is, what exactly is down payment assistance? First of all, foremost, it is not free money. Most important thing I want you to walk away from watching today's webinar, it is not free money. Most people think, hey, I'm entitled to a benefit because I'm a first-time home buyer. Here's the deal. None of us are entitled to anything, and most benefits come at a cost. Sometimes it costs you directly, sometimes it costs the global economic world, and everybody else has to pay for something that goes to you. In this case, it really costs you something in most cases. Most down payment assistance programs come with either higher interest rates than the loan would be if you didn't have down payment assistance, or higher fees than you would have paid if you didn't have down payment assistance, or both. So it's critical to understand it is not free money. If you have the money to pay for your own down payment and closing costs, you are likely better off doing so, because there's always some kind of a cost. And when we calculate it, it's typically that you're better off getting the money yourself instead of getting it from an assistance program. Now, another quick thought about down payment assistance that many people kind of gloss over: the number one source of free down payment assistance is a gift from family. Now, don't misunderstand. The fact is that when you get money from family, it might be free financially, but it's not free emotionally. There's a cost that comes with every dollar you get from a family member. So just recognize that everything has a cost, but sometimes people come to me saying, John, Grandpa's willing to give me $50,000, but I don't want his money because then he's going to feel like I owe him. Okay, well, I can give you assistance, but it's going to be a lot less money, and you are going to owe us, and you're going to pay a lot more money for it. So the question is, do you want to feel like you owe Grandpa, or do you really want to owe on your mortgage and pay more money than you need to pay? That's a really important thing to understand. So let's talk about what down payment assistance covers. Down payment assistance, depending upon the size of the down payment that you get, or the assistance that you get, can cover your actual down payments, and it can cover some or all of your closing costs. Okay. Each loan program is going to be different. Today, I'm not going to get into all of the different loan programs. I just want you to understand, when you get down payment assistance, that's just for the down payment. You're still getting a regular loan, whether that be an FHA, a VA, a conventional loan, or an USDA loan. you're getting a loan for the majority of your purchase price. As a matter of fact, VA and USDA require zero down. So why would you need down payment assistance with those? Because they cover the closing costs. So you've got an opportunity to get assistance even when no down payment is required, because most people forget or don't really think about the fact that when purchasing a home, you pay for two things. You pay for down payment and you pay for closing costs. And closing costs, typically $10,000 to $15,000 is on average. Some people will say 3% of the purchase price is average. I'm not sure I agree with that completely, but what I'll tell you is that when you're using down payment assistance, you're going to pay at the higher end of that range. It's going to cost you a lot more to do the loan in fees when you're using down payment assistance. So it covers those fees, but depending upon how much assistance you get, you may have more fees than what the assistance will cover. So you're still coming up with some money out of pocket. What doesn't down payment assistance cover? It doesn't cover any of your inspections. So if you're buying a home, even if I got you a great deal with down payment assistance and we paid all of your down payment and all of your closing costs, what it doesn't cover is inspections. Kathleen, I see your question. I'll get to it in a second. It doesn't cover the appraisal fee. You're still going to have to pay your out of pocket for that, typically around $500. It doesn't cover your earnest money deposit. When you write an offer with your real estate agent, your realtor is going to ask you to pay an upfront deposit to the title company that shows you're serious about moving forward. Now, if you don't have a lot of money to come up with, sometimes you can ask for that to be as little as $1,000, but you still have to have that money to come up with. So that's what's critical when I look at down payment assistance is you've got to come up with the $500 for your appraisal fee. You've got to come up with the $1,000 for your earnest money deposit. Now, if everything is paid for out of the closing costs via down payment assistance, you can get that $1,000 back, but you still have to pay it up front. And then any inspections you order with your realtor, a roof inspection, a home inspection, a pest inspection, any one of those inspections, you're paying out of pocket for those. So I tell people at a bare minimum, you've got to have $2,000 to $3,000 to buy a home. And so even when we talk about down payment assistance, even with options where you don't have to come up with anything out of pocket, nothing out of pocket is really $2,000 or $3,000 out of pocket. Now, Kathleen asked a question, do you have to have a specific credit score or debt to income ratio? Yes, you do, Kathleen. All right, moving right along. I'm kidding. All right, so I'll go back and I'll answer her question for real. So she said, do you have to have a specific credit score? Yes, you do. Each program is going to be different. Now, I'm going to talk about each of the programs. I'll give you a high level overview as we get through this webinar workshop. I don't know what I can call this 100 different things. Anyway, as we get through this, I'll explain some of the concepts. In general, most down payment assistance programs are going to require at least a 640 credit score. Some will go down as low as 620. Some have a minimum as high as 660, but in general, 640 is the answer. And yes, a lot of down payment assistance programs restrict how much of your income you can spend towards your bills compared to what you would be allowed to spend if you didn't use down payment assistance. So it's important to understand, not only are you likely paying higher interest rates and fees, but we're allowing you a lower limit on how much you can spend of your income, so it might restrict your purchasing power even more. Again, it's a case-by-case basis, but in general, they can be tighter. All right, so hearing from somebody new, oh wait, no, that's Kathleen again. By the way, guys, there's probably 12, 15 of you on right now, so feel free, anybody else that wants to ask questions. I love questions, and I appreciate that. So Kathleen says, can the earnest money deposit be a gift as well? Yes. If you're allowed to use gifts for the loan, you're allowed to use gift for the earnest money deposit. The only time you can't use gift money is if you're buying an investment property. So that's a good opportunity right now for me to set some parameters of this conversation. All of the programs I'm talking about are only applicable if you are buying a primary home. You cannot apply any of this to second homes or investment properties. Now, in this case, to answer Kathleen's question appropriately, you cannot use gift money on investment properties at all. So if you're buying an investment property, your earnest money has to be from your own checking account. But if you're doing any type of a loan on a primary or a second residence, you can get a gift for your earnest money. So that's a great question, Kathleen. All right. So we talked about what down payment assistance does not cover. Now let's talk about who's providing the money and why are they doing it, John? Well, here's the deal. Going way, way back in time, way back to like the 70s, Fannie and Freddie had been really the cornerstone of mortgage origination, that the mortgage industry shifted from before that being driven by banks. And you went to your local bank and you got your mortgage. And then Fannie Mae and Freddie Mac started becoming more and more prominent. And yet the general rule was you needed to put at least 20% down to purchase a home. And the banks really mandated that. And Fannie Mae and Freddie Mac came out and they said, you know what? No, we're going to let you put a smaller down payment. We're going to let you put as little as 5% down or sometimes 3% down. You just have to pay for mortgage insurance. FHA comes in and says the same thing. Hey, you can put as little as 3.5% down and all you have to do is pay for mortgage insurance. But even in those situations, they wanted to have some skin in the game. They wanted to have you participating with some down payment money to know that you're serious and you're not just going to walk away from this home. The problem is life has happened over the last 25 years. It's become harder and harder and harder for people to save up that money, given the fact of how much they're paying in rent. Rent is the hamster wheel. It's the never-ending cycle where you're going to continue to pay rent and you can't get ahead and your rent's going to go up. And you want to buy a home, the problem is you can't save money for the down payment because you keep putting all this money towards your rent, and it becomes a vicious cycle. And so the federal government stepped in and they said, you know what, the state governments as well, local municipalities have stepped in and said, you know what, we've got to help people be able to buy homes. There's more stability from homeowners. They're not going to move as often. They're more invested in the community. They're going to keep the community nicer. They're going to spend more time being invested in growing our community. And so we want to make homeowners out of these people that can't save money for a down payment. And so this money is coming from mostly state programs, some federal programs, and some local city and county programs. So we're going to talk about the different programs in general and some specifics about a few of the programs. But the fact is the money is coming because they're trying to promote home ownership within their community or within their municipality or within their state, because homeowners typically are more stable providers to the community at large. All right. So I want to talk for a minute about why is now a great time to buy if you need down payment assistance. And this is a very, very long part of the conversation that I'm going to condense into a really, really short part. So if you want to get a better idea of what I'm talking about, I did a video back in January that was my 2023 economic outlook. And I spent an hour, 45 minutes in that video talking about everything I'm going to cover with you in the next 2 minutes. Okay, so 2 minutes worth that I'm going to give you of 45 minutes worth of information. Now is a great time because sellers are willing to negotiate. That's it. We couldn't negotiate with sellers 2 years ago because there were too many buyers wanting to buy too few homes. Now, there's not more homes for sale. There's fewer buyers willing to buy because interest rates are up. And interest rates being up is your best friend right now because it takes away the competition. Sellers in general like bigger down payments. Now, that's kind of silly if you think about it because the money is money. And whether you buy a $500,000 home and you get $450,000 from the bank and $50,000 from the buyer, or you get all $500,000 from the buyer, you still get $500,000. The money doesn't spend any different whether it came from a loan, from cash from the buyer, or from a down payment assistance program. But it tells the seller something about the buyer's position and strength in case something were to go wrong, in case your car would break down. Well, if you're putting $500,000 on a $500,000 home, you're putting $200,000 down. The seller feels pretty confident that if your car broke down, you could still afford to buy this house. When you're literally putting only $2,000 out of pocket to buy a home and your car breaks down, that car breaking down could make the difference between the seller successfully closing on the sale or not successfully closing on the sale. So it makes you less attractive to the seller when there's a sea of choices the seller has to pick from. So what you need to understand is now is when sellers don't have as many choices. And the reason is simple, because most other buyers are scared. They're scared to buy with these higher interest rates because it means a higher monthly payment. Okay. But here's the other thing I want to tell you, which is that sellers are not sellers. A lot of people, including myself, will tell you, hey, now's a great time to buy because you can refinance later. I want to be super clear. Most of these down payment assistance programs require you to be able to pay back the assistance funds at the time you're refinancing. Now, the good news is you can pay back those funds by taking some more equity out of your home, only if the value of your home has gone up. So if you are someone that says, you know what, I'm going to refinance in 9 months because I'm positive rates are going to fall in 9 months. Well, you better be equally positive that prices are going to shoot up. I think they will, but sometimes we'll see rates fall and prices won't shoot up as much. And if that happens, you might not be able to refinance because you have to be able to pay back the assistance money at the time that you're doing the refinance in most cases. So Kathy commented, she said, I agree it's silly. So she's referring to when I said it's silly that, you know, cash is cash. If you got $500,000 from cash, or you got $500,000 from, half from the buyer and half from the bank. She goes, if the buyer has a good solid pre-approval letter, they're going to be able to close. And Kathy, what's the definition of a good solid pre-approval letter? Somebody pre-approved by yours truly. That's right. That is a good solid pre-approval letter. All right. Hopefully you all agree with that. If you don't, you can go ahead and click off the webinar now. All right. So let's keep going and let's go through some questions about down payment assistance and dive into some of the programs. First of all, do I have to be a first-time home buyer? No, you don't. Some programs will require you to be a first-time home buyer. More and more don't require that anymore. So if you think in the back of your mind that, man, I have to be a first-time home buyer in order to use down payment assistance, that is rarely true anymore. By the way, Kathleen agrees. I'm sure she's agreeing to the fact that the definition of a good solid pre-approval letter is somebody approved by me. Kathleen, if I'm wrong, please don't tell me. Just let me believe that. Okay. All right. So you don't have to be a first-time home buyer. That's a major myth that people believe is true, and it just isn't true. There are some programs that require it, but here's the cool thing. A first-time home buyer is defined in most cases by not having owned your primary home for the last 3 years. So if you owned a home and you sold it more than 3 years ago, you're fine. Now, it doesn't mean you haven't bought your primary home in the last 3 years. Some people misunderstand and say, hey, John, I own my primary home, but I bought it 4 years ago. So I'm a first-time home buyer because I haven't bought in the last 4 years. Not true. You are a first-time home buyer if you haven't owned in the last 3 years. If you have not owned your primary residence in the last 3 years, you are still a first-time home buyer. And here's the other loophole. You can own a home that isn't your primary residence, and you're still a first-time home buyer. So if there was a circumstance where you co-signed with your sister, or you bought a rental property with your uncle, that is not your primary home because you didn't live in it. Therefore, you still qualify as a first-time home buyer. Pretty cool loophole. All right. Does my amount of income matter? Absolutely. So here's where I'm not going to go too deep into the weeds because we could get stuck here for an hour. There are median income calculations for each metropolitan statistical area. What the heck is a metropolitan statistical area, John? Well, we call it an MSA. MSA, for example, in sometimes it's a county, sometimes it's multiple counties. So in Sacramento, it's actually multiple counties. Sacramento, Placer, Yolo, El Dorado, and Sutter, I think is the fifth one. Maybe it's only 4. Anyway, multiple counties come together, and that's considered an MSA, or metropolitan statistical area. And there is a median income. Now, I'm not going back to math. I'm not teaching you math. There is a median, there's a mean, there's an average. It's the median income. Google it, figure out what the median income is. I think it's half the people make less than this number, half the people make higher than this number. That's the median income. Not the average, but half the people above and half the people below. If I'm wrong, please don't tell me, but pretty sure that's what median is. The rules on most programs are tied to median income. Some of them can go double what the median income is. Some of them can only go 80% of the median income. Some will go 100 or 120% of the median income. But your amount of income matters because a lot of these programs are not just designed to help people who don't have a down payment, but really designed to help people who have the hardest time saving for a down payment. And that's the people who have lower incomes. So if you make $1 million a year, there's very few down payment assistance programs that are going to help you out because let's be honest, if you make $1 million a year, you should at least be able to save up 3% of your purchase price to put as your own down payment. And that's kind of how the system looks at it. All right, one of the things I want to talk about real quick right now is a side note, but it's super, super important. And it goes to income and really about debt to income ratio. And that is FHA just announced a huge decrease in their mortgage insurance premium. And they announced it on Wednesday, and there was some confusion on how it was going to roll out because it's got a date of March 20th, but it appears it's going to roll out even for people who are in escrow right now, as long as they're not closing in the next few days. Each bank's going to handle it. Each lender's going to handle it a little bit different. We're going through our pipeline right now and updating all of our clients that are in escrow that haven't yet had docs drawn using an FHA loan. Currently, FHA charges 0.85%, almost 1% per year for mortgage insurance. They're dropping that from 0.85 to 0.55%. And I'm going to run a super simple calculation for you here. And I'm going to pull it up here really quickly. Here's my calculator. So if I take a $400,000 home, or $400,000 loan times 0.85%, that means that they're paying $3,400 in the first year, or about $283 a month. If I change that to 0.55%, so 400,000 times 0.55%, it's $2,200 or $183 a month. That's a huge savings that somebody is going to get. That is an absolute huge amount of savings that they're going to get off of their monthly payment simply because FHA lowered the mortgage insurance. So this is really, really good, especially because conventional loans are getting harder to qualify. If you want, I have a video that's being released this afternoon that I go into more detail about that, but I thought it was critical to bring it up for those of you that are watching right now. Okay. Kathleen had a question, and I will go ahead, or Kathy did. Kathy and Kathleen are dueling banjos trying to see who can get the most comments. So let's see who wins by the end. Kathy said, can buyers buy down interest rates now? Permanent buy downs, no. Temporary buy downs, maybe. So CalHFA is allowing temporary buy downs, so we can actually buy down the interest rate temporarily, 2% lower the first year, 1% lower the second year, paid for 100% by the seller. So the answer is yes, you can do permanent buy downs, but you cannot do temporary buy downs. Okay. All right. Kathleen's cheating now. She's putting emojis in here to try and win the race for who has the most. So anyway, let's go ahead and keep going, and feel free to anybody else's name that doesn't start or rhyme with Kathy or Kathleen. I'd love to hear from you as well. All right. So can I use a cosigner? In most cases, no. In some cases, yes. And I know that's super vague, but I'm not trying to waste your time diving into each program. The truth is, I'm the expert on each program. I'm going to help you or your buyer or your friend pick which is the best option for them. But in general, these programs want you to qualify on your own. They want the occupants, the people living in the home, to qualify. And for the most part, they do not want you to be using a cosigner to qualify. All right. Yay, I get somebody other than a Kathleen or a Kathy. Elizabeth, thank you for posting. Why did FHA reduce the rate? Is it because they have enough in reserves? That is 100% correct. Matter of fact, FHA has too much money in reserves. So here's how so private mortgage insurance companies, that excess is money they call profit because they're for-profit organizations. The federal government runs the funds for FHA and for VA, and they said, look, we have statutory or laws that are written that say we have to keep a certain amount of money in reserves. And FHA's reserves are significantly greater. They've been collecting this 0.85 every single year from every single homeowner and collecting 1.75% up front. By the way, the 1.75 is not changing, but they've been collecting 0.85 every single year from all of these people. And the balance has grown so much because people haven't been defaulting on their loans. And so they have way too much money in the account. So they cannot change the mortgage insurance for anybody who has a current FHA loan, but they can change it for people who get new loans. So that's bad news for people that already have one. But if they refinance at some point down the road, they can either go to conventional with no mortgage insurance or FHA with this cheaper mortgage insurance. Just be aware, gang, they run this calculation every single year. I don't expect them to have losses this year, so I think that we're going to be fine. But if they start losing money, we could see this mortgage insurance premium jump up. It is not only a downward battle. It's been going both directions for the last 22 years that I've been in the industry. All right. So Kathy now has another question. When a buyer wants to buy down rates, can the savings of the interest negate the cost of the temporary buy down? Is that ever an issue? So the savings and interest is always 100% equal to the cost of the buy down on a temporary buy down. If you do a 2-1 buy down, 2% the first year, 1% the second year, the cost to the seller is 100% to the penny equal to the amount of savings the buyer gets off of the 2% the first year and off of the 1% the second year. So there's not a matter of can it negate the cost? It is the exact cost, because with a temporary buy down, the truth is the bank is still earning the full interest. The only difference is that you've got money that has come in from the seller at time of closing that's sitting in a bucket that's supplementing that payment every single month. So I hope that makes sense, and I'm going to jump back into my presentation here. Again, keep the questions coming, and feel free, again, if anybody else wants to jump in. Elizabeth, feel free to jump into the race and see who can get the most comments before the end of the meeting. All right, so we talked about, can I use a cosigner? Let's talk about, are there any limitations to the types of properties I can buy? Yes, there are, but not as bad as what you thought. So in the past, it's always been condos are acceptable and you can do a single family residence. But in the past, you were never able to do 2, 3, or 4 unit properties. You weren't able to do manufactured homes. I have super good news. I'm actually super excited to tell you that I have one program that allows you to do a 5% down payment on a conventional loan on up to a 4-unit property, and you can get 5% of the purchase price as assistance. So if you've got somebody that wants to purchase a home and they are using down payment assistance, they don't have a lot of money out of pocket, and the truth is they're worried about, hey, my purchase price will only go so high for a single family home. Well, they can buy up to a 4-unit property. I can count the rents from the other 3 units to help them qualify. So they can buy a much more expensive home, and they get 5% down, and we have 5% assistance. Now, don't think that means no money out of pocket, because the fees are going to be a lot higher than normal. So, but the rates are really, really good. So there's some really good wins in this scenario. All right, I got 3 comments I got to tackle. My throwing out the gauntlet. Penny, woohoo, I got another person in the race. Penny says someone's getting interest on that money. That is 100% correct. Going back to the temporary buy down, the interest is being earned. The temporary buy down just is coming from the seller. All right, man, we've got Elizabeth. Is that new MI now closer to what conventional is for a 3 or a 5% rate? Yes, it's a lot closer to what conventional is. For 3% down, that's pretty close to what you're going to see on a conventional loan. And here's the interesting thing. On a conventional loan, if you have perfect credit, you might have mortgage insurance of 0.3% per year. But on an if you don't have absolutely perfect credit, you're going to be 0.5, 0.8, 1%, 1.5% per year. Conventional is a sliding scale. FHA is a singular number. So that 0.55 puts you a lot closer, especially if you're not the cream of the crop perfect buyer. I actually see a lot more buyers that are in that middle range that we used to say, hey, go conventional, it's better. It's actually going to be cheaper because FHA's rates are cheaper than conventional. And the mortgage insurance is equivalent because for somebody who's not a perfect buyer, you're going to have pretty expensive mortgage insurance. Now, this goes back to the whole thing about what is the seller's mentality. Sellers would rather see a conventional loan than FHA. So it's going to create some issues with making your offer as competitive as we can. But when it comes down to truly what is best for the buyer, there are going to be more cases this year where FHA is going to make sense, when in the past we used to think conventional was making sense. Now Kathleen's getting out of control, simply adding wows, and that's very cool. She said that's very cool, and then she said, yeah, you can refi. By the way, I'm encouraging this. I will tell you, Kathleen's in the lead. So Kathy, Penny, Elizabeth, you guys got to catch up here. You know, you can add some extra things, and then Kathleen says, oops, later. See, she even misspelled something on purpose so that she could write another comment to correct what she misspelled. I think that's ingenious marketing. Good job, Kathleen. All right. So you are still limited on some of the rules on different property types. So all programs allow single family residences. Most allow condos. Only one allows 2, 3, and 4 unit properties, and a few of them allow for manufactured homes. So just to be clear, lots of different rules. But the cool thing is we've got ways to do small down payments, even up to a 4-unit property. Do I have to pay back the funds? Maybe. There's actually really 3 different types of assistance. You've got loans, you've got grants, and then you've got assistance, the new programs that are coming out that have shared appreciation. I'm going to talk through all of those in a moment. All right, we got another contender coming in. Athena is laughing at all of us because we're having this competition, and she had to put an emoji in there so that she could compete as well. I love it. All right, so if it is a loan, you do have to pay it back. Okay. Now, sometimes there's forgivable loans that feels like a grant that the money doesn't have to get paid back as long as you keep the home for 3 years. So that's something to be important to understand the details of whether it needs to get repaid. And in those situations, if you refinance before the end of that 3-year time frame, you didn't keep that loan for 3 years. Therefore, you have to pay back the portion that hasn't been forgiven yet. Most of them forgive 1/3 per year for each of the first 3 years. All right. Samia, we got another contender jumping in here. How do student loans play a role? Whew. All right, student loans, I'm going to oversimplify this and say student loans simply are a debt. And every loan program requires us to count that debt. Most people right now are in forbearance. Their student loan, they're not making a monthly payment, but we still have to count that. So it won't hurt you from buying a home. It won't hurt you from using down payment assistance. But what it will do is it will make your payments more expensive in the total debt to income ratio. And some programs are more forgiving than others, meaning Fannie Mae treats it different than Freddie Mac versus FHA versus VA, but student loans absolutely play a role in the total debt to income ratio. Okay, so let's get to the meat of this. Let's talk about some specific programs. So the first one's one I bet you've all never heard of, and it's called the WISH program. So the WISH program is actually a federal program. It comes out every year on April 1st. Guess what? April 1st is like 4 weeks and 4 days away. So every year on April 1st, the WISH program rolls out. And the WISH program, Kathleen, I'll cover that question in a second. The WISH program is a second mortgage only. It's one of the only down payment assistance programs that I can tie to a normal first mortgage. Just be aware, conventional loans charge you more if you're doing a normal conventional loan and you have a second mortgage than if you were doing your own down payment. So you pay a little bit higher interest on the conventional loan, but you can tie this to conventional or FHA, and you pay nothing extra on FHA for tying the WISH program behind it. Now, the income limits are very, very low, meaning this is what is called very low. You've got low to moderate income on that area median income calculation. And this is for very low income earners. I'm not going to go over what the dollar amounts are, but the bottom line is it's very low. Your average person is not going to be able to use this program. But the truth is, this is really designed for that person that thought, I could never be a homeowner. I don't make enough money. I can't make it work. And we can find a way to make it work, especially in this market where we've got some less expensive homes out there. I'm seeing some homes in sub $300,000, even tickling $200,000 right now for some condos and some townhomes. Those are the types of homes that this program can work for. It's a matching grant program. For every dollar that the home buyer puts in, $4 is matched. So therefore, basically, if you have $6,000 of your own money, then they will match that $6,000 4-to-1. You put in $6,000, they put in $24,000. That adds up to $30,000. Now the maximum is $29,000. Therefore, they're only going to put in a smaller amount. They're going to put in whatever the $23,000, so that you end up with the $29,000. But the bottom line is the WISH program is a really good program that runs out of money quickly. So if you know someone that's in the lower income brackets that doesn't think they can buy a home, they've got good credit, they just aren't able to save up for a huge down payment, but they can come up with $5,000 or $6,000, and that is a huge opportunity with the WISH program. All right, let's go back. Actually, let's go here and say, Kathleen said, is there an income limit for those buyers? There is. I don't have the income limit in front of me. Matter of fact, let me see if I can give a rough idea. Google this real quick. So if you ever want to look, it's Fannie Mae, FNMA, and then AMI, an area median income. And I will show you guys really quickly here how this tool works. So let's see if I can share my screen. Present and share screen. And go right there and share it. Beautiful. And you guys should be able to see this. This is the Fannie Mae Area Median Income Lookup Tool. And I'm going to look up here, Lodi, California. And it's going to zoom into Lodi, California. And it is going to tell me that now I've got to double check. I'm not sure if it's at the 50% level, which is 42,500, or if it's at the 80% level. I am pretty sure it's the 50% level. So that means somebody buying in San Joaquin County can't make more than 42,500. But the truth is there are people who are buying that make less than that and just think they can't afford it. And this is a way to help them to purchase. So very, very good opportunity. I can show real quick in the Sacramento area. Again, I'm not telling you this is exactly the number, but I'm 99% sure it's the 50% number. And so we're looking at $51,200 is the maximum. So hopefully that helps answer the question. I'm going to stop sharing and come back here. All right, now let's see what else we have. Ooh, I got another person jumping in here as the contender, Mandy. Hi, Mandy. She said, no one wants to live there now. They have the worst, they are in the worst places, $300,000. Yeah, I do get it. I understand that the lower priced homes definitely are in lower neighborhoods or neighborhoods that aren't as good as the higher priced homes. But here's a concept that I think we've lost in society. Starter home. A starter home is not your dream home. A starter home is somewhere to get started that you build equity, okay? I think of the housing market as a train that's barreling 80 miles an hour down the track, and you're standing on the station trying to jump on that train as it goes 80 miles an hour down the tracks right past you. Pretty hard to jump on that train. You can, but it's pretty hard. But if you are jumping onto a slower train, you jump onto a train that's going 40 miles an hour, it's easier to jump onto that train that's going 40. And then as you're on that train going 40 miles an hour, the train you really want to be on is going 80. It's easier to jump onto that train. So I agree those homes are not the most desirable homes, but for a lot of people, the concept of a starter home is something that's been lost in society, and I think it's something we need to pay attention to. All right, so Kathy asks, rents are going up, so who can afford rising rent? That's my point, right? Like, here's the deal. Home ownership, once you become a homeowner, typically becomes less expensive per year on your monthly payment over time. Renting becomes more expensive per year over time. So it's critical that you understand that jumping on that train, and whether it's the 40 mile an hour train or the 80 mile an hour train, getting on the train is what's important. All right, I think the last comment I didn't cover is Kathleen saying, do you still have to hit the buyer for 1% of the loan if they're not paying on them? She's referring to the student loans. I waited on this one for a couple of minutes because I wanted to finish talking about the WISH program. No, some programs allow us to have 0.5% of the monthly payment. So that is an option on a case-by-case basis. And then Kathy said, no tax benefit to rent. I totally agree, Kathy. Being a renter, you lose that tax write-off. And there's a lot of people who make good money that can afford it. They just can't afford the down payment. And that's what all of this is going to help with. All right, here's my next super fun program. You guys have heard me talk about this a little bit if you've been following me at all, but there is a new program that's going to be rolling out sometime this spring. I say spring, we don't have a date. Spring has sprung soon. I don't know, pouring rain today, so maybe not. But this program is called California Dream for All. It is going to be run by the CalHFA program. So it's at a state level. The governor signed the bill. This is actually started back in summer of 2021 that they started pushing this and wanting to do it. The governor has now allocated the funds. They're going to be rolling it out early this year. Here's what it's proposed to look like, and we're 90% sure it's going to look like this. You will be able to get up to 20% of the purchase price as assistance. So if you are buying a home for $500,000, you can get $100,000 from the state that will help you with your down payment. Now, you can use that to cover down payment. You can use it most for down payment and some for closing costs, multiple ways we can put this together. But the fact is, you're going to have a significantly lower monthly payment, or you're going to be able to qualify for a higher purchase price. Pretend for a moment, if you will, that you only qualified for a $400,000 home and you have no money for a down payment. But as you're looking around out there, you see that homes in that price range aren't what I'm looking for. Even what Mandy said earlier about nobody wants to buy a home because they're in bad neighborhoods. Well, let's pretend that where you're living $400,000 is a bad neighborhood. Then guess what? You can use this program to say, hey, instead of buying a $400,000 home and putting a little bit down, I can buy a $500,000 home because I'm going to have a 20% down payment from the state of California as assistance, so that I'm making my payment on the 400, but I'm able to leverage and get the house I really need for the safety, security, stability of my family. I think this program has tremendous opportunity, and I think this program is going to run out of money like that. I expect my projection, probably 6 months, and this program is going to run out of money. So it's about jumping on the opportunity. I'm creating an interest list now. So if you or anybody you know wants to get pre-approved for this, we want to get started now so that when the money is available, we can get you out shopping immediately. But here's the deal. Sounds all great and good because you get 20% for your down payment, but you share in the appreciation of the home. What do you mean share in the appreciation, John? Like, I appreciate my home and they appreciate my home, and therefore we're sharing in the appreciation? No. So shared appreciation, Mandy, I love your comment. How soon can we apply? We can apply now. You can get the process started with me. I cannot reserve, actually, I can never reserve funds for you. You don't reserve funds until you get an offer accepted on a home, and then we allocate the money to you. We cannot start you shopping for homes and writing offers under this program until they release it. Some chatter I've heard is that it should be sometime in April. I'm not so confident in that, so I'm not going to tell you that's for sure. But what I'll tell you is that I am hearing that it should be sometime in April. What they're saying for sure is that spring of 2022, but spring, what's the definition of spring? All right. So Kathleen asks, is this a silent second? Or she said, is this a second loan where there's an interest rate? So the California Dream for All, you pay no interest. What you're paying is you're paying for the appreciation on your home. And I'll explain what that means in a second. Elizabeth asked, is the California Dream for All program for all buyers? So there are, I am reasonably confident. Again, I've read through this a few times, but it's blanking for a moment. I believe that they are going to require you to be a first-time home buyer. So if you have not owned a home in the last 3 years, then you would qualify for it. Mandy said, what is it called? It's called California Dream for All. And by the way, don't misunderstand. You're going to find web pages out there that says, click here to apply for the money. The truth is that person is the same as me. All they're doing is marketing and basically making you think they're the portal that you're actually using to reserve the money. They're not. So don't click on anybody else's website. Don't go anywhere else and say, oh, this guy said he can get me the money reserved now. Nobody can. He's just using a little bit of bait and switch to tell you, apply with me now, and then I'll help you get the money later. So you're here listening to me. Please trust me. I will take great care of you. You can look it up, California Dream for All, but don't click on anybody else's link to apply and give them your information. All they're doing is trying to get your information and sell it to a whole bunch of lenders that are going to call you 24 hours a day, 7 days a week, and annoy the heck out of you. Okay, so let's go back to the actual California Dream for All program, and let's talk about what shared appreciation means. Shared appreciation means you buy that house for $500,000, and the house goes up to $600,000 when you go to sell it. You have gained $100,000. Therefore, you're paying 20% of that $100,000 back to the state when you pay them back the $100,000 that they loaned you. So mind you, you're able to buy a $500,000 home that previously you were only going to be able to buy a $400,000 home. That $500,000 home went up by $100,000. You're paying $20,000 or 20% of that appreciation. Now, if you said, John, I don't need 20% assistance, I can get by with only 10% assistance, then you only have to pay back 10% of your appreciation. So don't take more than you need. It's like my dad told me as a kid, put whatever you want on your plate, but make sure you eat everything you put on your plate. So here's the deal. Don't put more on your plate than you need because it's costing you more later because you took 15% for down payment. You're paying back 15% of your appreciation. Now, there's a cap. I think it's 2.5 times the money you borrowed. So if you got $100,000 in help, then their portion of the appreciation can be no greater than 2.5 times that, or $250,000. That's a lot of money. That cap rarely is going to kick in. But if you think about it, the average home in California appreciates by 5% per year. Well, if the home's appreciating by 5% per year and you're paying 20% of that appreciation, then 4% goes to you. 1% per year is the interest that you're paying. 1% ain't so bad. So people freak out. People I've talked to have worried and said, John, I am not going to share 20% of my appreciation. Well, if the value goes up so much in 1 year, yeah, you're going to pay a lot of money, but good for you that you were able to buy. Because otherwise, if you didn't have this program, you wouldn't have been able to buy. And guess what? 100% appreciation on renting. Oh, wait, the landlord doesn't share the appreciation with you. There's no benefit. So having the appreciation and at least getting 80% of it is better than getting nothing. All right, let's go back to my questions here. So Kathleen says, when do you pay? You pay no monthly payments. You pay when you sell your house or when you refinance. Now, they haven't given enough details, because I'm worried, what happens when you refinance? How did they determine? I'm guessing they're going to say whatever the value is at the time that you're refinancing, you have to pay back the amount of money we loaned you, plus 20% of the increase from then until now based on the appraised value. That's my guess. But guess what? It's just a guess. They haven't released enough information. Okay, Mandy's asking, what is the qualifying credit score? They haven't released any details like that. My best guess is going to be 640. CalHFA is sponsoring this, and most of the CalHFA programs require you to have a 640 credit score. So that's going to be my best guess. By the way, here's the coolest thing about the California Dream for All program. If you were only buying a $400,000 home and you were getting a normal 3 or 3.5% for a down payment, you have a huge amount of mortgage insurance you're paying. But if you put 20% down that comes from the state, you pay no mortgage insurance, or really, really cheap mortgage insurance if you have to have some of that money used for down payment for closing costs. So there's an actual huge monthly payment savings because you're able to not have to pay mortgage insurance. So it's very, very helpful, this program. All right, I'm going to move on to 3 or 4 other programs in the 7 minutes we have left. I know we have questions popping up. Let me take a look and see if the question is pertinent to this. Kathleen says, how long is it? Kathleen, you are ahead of the game. I don't know. My best guess, we can get a CalHFA loan done in less than 30 days. I don't think the paperwork on this is going to be any more difficult. So my best guess is going to say less than 30 days, but we're not even within 30 to 45 days of release of the program. So I'll have more of those details as we get closer. But great question and great job in increasing the number of comments that you have posted. So thank you. All right. The next one I want to talk about is the Golden State Finance Authority. The GSFA has 2 different programs. They have the Platinum program and they have Open Doors program. Okay, so the Platinum program is a loan and a grant. And as a matter of fact, the Open Doors program is also a loan and a grant. All I'm going to say about these programs is that there's a difference in rules on how much money you have for assistance, how much money you're getting in assistance, and how you pay it back. And the interest rates are different. The Platinum program in general has better interest rates than the Open Doors program. I'll help guide you through all of those differences. But here's a couple of cool things about the Platinum program. There's 3 versions of it, and I offer all 3. The first version is for everybody. The second version, and by the way, I'm looking up something here really, really quickly, which is I am pretty sure that for the first version, you do not have to be a first-time home buyer. I'm not seeing it. Anyway, borrower eligibility, first-time home buyer requirement is not required. So you can use the Platinum program and not be a first-time home buyer. So that's a huge benefit to the Platinum program. That first tier is for everybody. The second tier is for people who work in a particular industry. Now I moved my page and I lost what the industries were. Give me 10 seconds and I'll pull up the industries. Okay, so if you are in medical field, which is a medical or healthcare worker, law enforcement, so if you're a peace officer, sheriff, border patrol agent, correctional officer, or other serving in a law enforcement capacity. If you work for fire, so firefighters, CAL FIRE, paramedic, EMT, including administrative staff, or if you work in education. So current members of the California Teachers Association, University of California Retirement Plan, California Teachers Retirement System, CalSTRS, or members of the University of California Retirement Plan, employees of a California accredited private, charter, or public school, university, junior college, or private college, including school staff and administration, part of your assistance money is a grant. Now you pay interest on the money that's not a grant, but you get money granted that you don't have to pay back if you're in one of those fields. So there's a grant program that you get free money if you're in one of those fields. And then the third tier is even better, but it's kind of a weird niche that they're filling here, which is if you are a current county employee. So if you are working for the county in one of these counties, I'll read them off quickly: Alpine, Amador, Butte, Calaveras, Colusa, Del Monte, El Dorado, Glen, Humboldt, Imperial, Inyo, Lake, Lassen, Madera, Mariposa, Mendocino, Merced, Modoc, Mono, Monterey, Napa, Nevada, Placer, Plumas, San Benito, San Luis Obispo, Santa Barbara, Shasta, Sierra, Siskiyou, Solano, Sutter, Tehama, Trinity, Tulare, Tuolumne, Yolo, and Yuba. Whew! Really, there's a lot of counties around Sacramento. So not Sacramento County, but Placer County, El Dorado County, Solano County, Yolo County. A lot of those counties, if you are a county employee, you not only get what the firefighters and the medical workers get, but you actually pay no interest on the portion that is a loan. So you get an interest-free loan and a grant if you are an employee of one of those counties. So if you know somebody who's an employee of one of those counties that wants to buy a home, or if you're a real estate agent looking for a place to market, you should be marketing to people who are employees of those counties, because we have a special program to give them as close to free money as we've got, because you get up to 5% of the purchase price, and part of it is an interest-free loan and the other part is a grant. So that is the best of all of the down payment assistance programs I'm aware of. All right, the next one is CalHFA. CalHFA is really has been the gold standard of down payment assistance for quite some time. The Platinum program's coming back into play, especially with these special programs. CalHFA or CalHFA used to have a program that would allow for teachers to get a better deal. They don't anymore. So really, there's nothing special about a particular occupation. There you go. Nothing special about a particular occupation with CalHFA, but they've got pretty good terms as far as interest rates are concerned. They've got some of the most flexibility in the industry as far as loan programs. The MyHome simply covers your down payment. You got really attractive interest rates, but it only covers your down payment, which means you're paying a pretty high amount of closing costs on these down payment assistance loans. But if you're in a position where you can get a seller credit, you can get a really good interest rate and put zero down payment and just get a seller credit to pay your closing costs. If you're in a position where it's like, hey, John, I need more money for assistance, they do have what's called the ZIP program. It's misleading. ZIP means nothing. But the truth is, you don't pay any interest on an extra 2% or 3% of your purchase price to help pay for closing costs. But you pay a huge increase in your interest rate on your primary mortgage. On the first loan that we do, the rates are way higher, 1.5%, 2% higher. It's just not worth it in today's market, but it is a good opportunity depending upon case-by-case situations. All right. Kathleen asked if we have a flyer about the 5% down option for particular industries. I don't know. Anna will check on that and we'll get back to you. So if we don't, we'll make sure we get one. Two more things I want to talk about in the few minutes that we have left. General statements. There are city and county run programs, and they're different in, let's guess it. Come on, everybody. Every city and county is different. Pretty much every city and or county has a community development department. It's the community development department's job to try and develop the community. And part of that is developing home ownership or getting more people to be homeowners in their particular community. In the Central Valley, San Joaquin County has a program. City of Lodi has a program. They've been out of money and unable to replenish that money for a few years. So they have a program, but the program doesn't have any money. And they need to find a funding source for it. And typically that's some kind of a grant from the federal government. And the grant money is being spent in other places. So many of these municipalities don't have active funds to give. Google them, take a look at them. We can participate in most of them, but most of them are out of money. A couple examples though, for example, up in the Sacramento market, the city of Rockland has a program. The city of Rockland's program has particular homes in a particular condominium complex that you can buy, and they're called deed restricted homes. That means that somebody bought the home and is living in the home, but the price they resell it for, first of all, they can't resell it just to anybody. They buy it for below market price, and they have to sell it for a below market price back to the city, and the city turns around and sells it to somebody else at a below market price. So it's a great option. You get some down payment assistance. You become a homeowner. You get the tax benefits of homeownership. You'll get some appreciation, but not all of it, because they're capping. They're selling the home below market price, and they're keeping that home in the family, and they're going to sell it to another person at below market price when you don't want it anymore. So there's some cool programs. If you dig deep into particular cities and counties, sometimes those programs require that you either live or work in that city or county. Sometimes they don't. So just be aware of that fact. And then the last thing we've got, by the way, if you have other questions, we've only got a couple of minutes left in our time here. So my next slide is really questions and wrap up. So please post your questions about anything that I've talked about, or just how amazing you think I am. Feel free to post that as well. So my last thing is lender proprietary programs. I got to tell you the truth, I misspelled proprietary, but I Googled it. I got it right before I got on the air. So lenders come up with programs, and there's two types of programs. There's the real ones and the not real ones. Well, John, what does that mean? It's kind of like seller credits from a builder. There's the real seller credits from the builder where you're really saving money, and then there's the fake ones where they just make it look like you're saving money, but they charge you more somewhere else. There are Community Reinvestment Act requirements from depository institutions. What does that mean, John? It means if you're a Wells Fargo, you collect interest by taking deposits from a community, and the federal government requires that each of those large banks gives money back specifically into the community that they are getting the deposits from. So it's called Community Reinvestment Act, requiring the money to go back into that community. One of the ways they do that is promoting home ownership through small down payments, reduced interest rates, no mortgage insurance. You're going to hear sometimes large banks come out with programs that say, hey, we've got a zero down program with no mortgage insurance. That's real. That's a small, short time thing that they're doing because they have not reinvested enough money into the community. Now, other times you're going to see that based on particular demographics. We're going to target a particular neighborhood. We're going to target a particular culture. There's some things they can do in targeting certain things that have to do with heritage, that have to do with background, that is legal. And they're allowed to do that because that matches the demographic of the community that they're getting the deposits from. So those are the legitimate ones. When you see a big bank talk about it, it's likely legitimate, but there's a real small hole you got to fit into, a real small box you have to fit into to make it work. And then there's the ones that look great from a lender, but all they're really doing is jacking up the interest rate to make more money in the long run to pay for the assistance. I see it all the time. I have realtors forward me, hey, John, do you offer this program? It's not really a program. It's the lender partnering with some other bank, and they're just charging you more money in fees, way more money in fees, way more money in interest, and it's gimmicky. And so be careful of those programs. Run them by me. For all the legitimate programs that are truly sponsored by the state or sponsored by the city or sponsored by the county, I participate in almost all of them. I haven't come across any that I don't participate in. But there's some wonky programs that are lender specific, and they're going to make it seem like they have the best thing since sliced bread. They never tell you what the interest rate is. They never tell you what the fees are. All they're trying to do is to convince you to call them, which is great. That's what marketing's about, but it really isn't a better program. So be careful of some of the lender proprietary programs. All right, guys, I am at 59 minutes and 15 seconds out of my hour. So right on time. It is now time. If you have any questions at all, please post them now. I'll stick around for an extra minute. I really appreciate all of you being here. Remember, every single Friday at noon, I'm here with my Financial Friday. The third Thursday of every month, except in March, it'll be the fourth Thursday because the third Thursday is my son's birthday. I do a how to buy a home masterclass. So if you are looking to buy a home and you want to get a 90-minute masterclass on the entire process of buying a home, go to howtobuymasterclass.com and register for my next webinar. I also have previous webinars recorded and saved into my YouTube. So you can go to my YouTube channel at youtube.com/John Lone King. and you can see my prior webinars on my masterclass. So I really appreciate everybody being here. The last few comments, I got some thank yous. So Elizabeth, thank you for saying thank you. Janet, your first comment, you didn't get into the race on trying to catch everybody, but you got one right at the end. Kathleen, thank you. I appreciate it. I appreciate everybody being here. Please don't keep me a secret. So if you know somebody that needs great advice about purchasing or refinancing of a home, yes, there are times when people still need to refinance. I want to interview to have that job and to take great care of you and anybody you know. I am working this weekend, so give me a call if you need anything, and we'll talk to y'all soon. Bye-bye.